Hello again, everyone. This is the first video for Chapter 5. Chapter 5 all about cost, volume, profit analysis, a big topic for cost accounting. This video will cover the first couple learning objectives, sort of the fundamentals of CVP analysis, and some considerations and assumptions. So speaking of assumptions, there are a few that we typically make with respect to certain factors to help simplify our CVP calculations. And the first is that selling price is constant. And that doesn't mean we never change it over time. We just mean constant in terms of not affected by volume. So we're assuming that we don't make a lot of concessions as far as volume discounts or anything like that. We also assume, and this is consistent with what we've been doing earlier this semester, that costs are linear and can be accurately, pretty reasonably divided into variable and fixed components, so that if a cost is mixed even, we can at least separate it into its separate variable and fixed pieces. We're also assuming that the variable costs are constant per unit and that the fixed costs are constant in total over that entire relevant range we spoke about. So relevant range meaning just the range of activity in which we expect to really operate. And then in multi-product companies, we generally assume that the mix of products sold remains constant, at least within any particular period or scenario. And by mix, we just mean the relative portion in which we sell products. So let's say we're Chick-fil-A and we're selling, the grilled chicken sandwich and the fried chicken sandwich. We're talking about the mix of sales for those two items, 60% fried versus 40% grilled, or 80-20, or whatever that happens to be. So the first learning objective then was to explain how changes in activity or volume affect contribution margin, that new subtotal we spoke about way back in Chapter 1, and then eventually net income. So in Chapter 1, we introduced this idea of the contribution format income statement. And that income statement groups all expenses by behavior rather than by function like our traditional income statement. So remember, the top and bottom lines were always the same, sales to net income. But in between here on the contribution format income statement, we had variable costs or expenses deducted from sales to get us to that subtotal known as contribution margin. How much was left to contribute toward covering the fixed expenses and then generating some kind of positive net income. So contribution margin minus all of our fixed expenses leaves us with our net income. And just as a quick point, if we're thinking about our mixed costs, those costs that have variable and fixed pieces, just keep in mind those would show up in both places here. We'd take the variable piece and stick it up here, and we take the fixed piece and stick it down here. So this contribution format income statement is pretty helpful for managers in trying to judge the impact on ultimate profit of changes in all those other pieces. So the selling price, different costs, or the volume of production and sales itself. Now, sales, variable expenses, and contribution margin can also be expressed on a per unit basis, and typically they would be. We don't usually express fixed expenses on a per unit basis or net income because remember, these things aren't moving in an exact correlate with activity like the other items are. So let's take a quick example here, Racing Bike Company. Let's say they've got on their contribution format income statement the numbers we show here. So they're selling 500 bikes at $500 per bike for a total of $250,000. They've got variable expenses per bike, so the cost of the bike frames, the tires, the wheels, whatever, $300 per bike. So a total of $150,000 across 500 bikes. And that leaves them with contribution margin of $100,000 total, or $200 per bike. Then they've got fixed expenses of $80,000 total, and right now they've got net operating income, or at least in this most recent period, of $20,000. Now, one thing to keep in mind right off the bat here is that this contribution margin per unit is an extremely useful tool for decision making in management. What it tells us is how much every single unit of product I sell contributes toward covering those fixed expenses and then generating a profit. Again, that's why this per unit information becomes very, very useful on the contribution format income statement. RBC in this case knows that every bike they sell, we're assuming for a second they only sell one type of bike, every bike they sell contributes $200 toward the bottom line. Right? So if they only sell one bike in a current period, then they only contribute 200 toward covering these fixed costs, and they've got a big loss of 79,800. Right? They sell two bikes, they have total contribution margin of 400 toward covering these. Three bikes, 600, and so on and so on. So contribution margin per unit, something we're going to be using a lot going forward. You read about in chapter 5 this idea of break-even points, and we'll get to that in another video. But for now, let's just point out that on the contribution format income statement, the total fixed expenses are what need to be covered to reach that break-even point. So in RBC's case, they've got to generate 80,000 in total contribution margin to reach a break-even point being where net income is exactly 0. And so for RBC, that's going to be 400 bikes. Each bike contributes $200 toward that bottom line. So 400 bikes times $200 is exactly 80,000 in contribution margin, leaving them with net income of exactly 0, and that's the break-even point. And again, we'll do more with break-even analysis coming up in that video. Now, worth pointing out here that this stuff extends in both directions beyond the break-even point as well. So if RBC sells one more bike, right, 401 instead of 400, their net income will be exactly $200. And it's not a coincidence that the contribution margin per bike is exactly $200. Again, every bike I sell in this scenario generates $200 toward the bottom line. So if I sell one bike above break even, my net income will be exactly $200. If I sell two bikes above that, so 402 bikes total, my net income would go to 400. 3 bikes, 600, 4 bikes, 800, and so on up through some kind of infinite amount. Now, part of the reason this becomes so useful in terms of planning and decision making is that we don't need to prepare an entire income statement to estimate profit at particular sales volume or activity levels. Instead, we just need to take the number of units sold, either above break even or below break even, multiplied by the contribution margin per unit, and that'll tell us where our income moves above or below that break even. Or we could just do it in general and factor in the fixed cost, and that's what I've highlighted here. Number of units sold, in other words, times that CM per unit gives us total CM, minus fixed expenses would give us our profit. So if RBC sells 430 bikes, its net income would be $6,000. That was 30 bikes above break even, times the 200 per bike in contribution margin generated for that total of 6,000. Or again, 430 times $200 minus their fixed expenses gives us the same profit. Okay, so a little bit of kind of shortcut there using the information we glean on that contribution format income statement. Now, as much as I don't love using the words, equation or formula in this class, we can express the contribution format income statement itself as really a profit equation. So that would be profit, the bottom line on the income statement, equals sales minus variable expenses. So what's in the parentheses there is really just the contribution margin minus those fixed expenses. Okay, so we're just talking about it's kind of the flow here from top to bottom of that contribution format income statement. Now we can also factor that out to look at this on a quantity level or quantity basis. What I mean there is we can take sales, and this was implied to be total sales, and I can break that out into a quantity sold times selling price per unit, Q times P. That's just total sales. I can do the same thing with variable expenses in total. That's just the quantity sold times the variable expense per unit, which, as you know from our earlier study, any variable expense assumed to be constant on a per unit basis. So as activity changes on a per unit basis, that stays the same. So really, with some rearranging then, I can express this profit equation from the income statement as P times Q, that's total sales, minus V times Q, total variable expenses, minus the fixed expenses. You probably see where this is going. I can then further factor that out to incorporate this idea of the unit contribution margin. Okay? So in other words, I can simplify what I had there on the previous slide into P minus V, so price minus variable expense per unit, times Q minus fixed expenses gives me profit. And really P minus V is just the unit contribution margin. Selling price minus variable expense per unit. And this is what we had before. CM per unit, how much does each unit I sell contribute toward potential profit, times quantity sold, minus total fixed expenses gives me that bottom line profit from the income statement. All right, so our second learning objective was to prepare and interpret a CVP graph and a profit graph. So all these relationships can be expressed graphically in a CVP graph, and sometimes it's very helpful to do that. We just have to pick various points at which to plot these expense and income items. So let's say for RBC, we put together, rough income statements at the following sales level. 0 bikes sold, 200 bikes sold, 400 bikes sold, which was the break-even point, and then 600 bikes sold. Our CVP graph is going to start by constructing the X and Y axes. Dollars would be on the Y axis, units, activity, volume, however you want to think of that on the X axis there. First, we're going to draw a horizontal line to represent total fixed expenses. Right, so in the case of RBC, they had fixed expenses of $80,000. We're assuming that's not changing regardless of volume. That's what a fixed expense kind of implies. So we're drawing that right across at $80,000. Then from there, we're going to draw the total expense line. So the intercept is at the fixed expense point, 80,000, moving upward in a linear fashion from there. So we had plotted that out at 0, 200, 400, 600, and so on. And so connecting that line. Then we're going to draw the total sales line. So that does start at the origin or 0, right? If we sell 0 bikes, we have 0 in sales. Every bike was selling for 500 bucks. So at 100 bikes sold, 50,000 in sales, 200 bikes, 100,000, and so on and so on. Now you can see where we're headed here. The point at which sales intersects with total expenses, there's my break-even point. And we already demonstrated that to be 400 bikes for the case of RBC. Right, so total sales and total expenses exactly the same. There's my break-even point. Now everything above that point, is all profit area. Okay? Every bike sold above 400 in RBC's case, generating some positive profit. Everything below that point, there's my loss area. Again, just really helps us highlight that critical tipping point, that break-even point, and where my profit and loss areas in terms of volume are. Now moving on to learning objective 3, we're going to use the contribution margin ratio, we're going to define it too, to compute changes in contribution margin and net income resulting from changes in sales volume. So we already talked about what contribution margin is, right? In total, it's the amount left over after deducting variable expenses from sales that can go toward covering fixed expenses and generating a profit. We can express that though as a percentage of sales to get this idea of a CM ratio. So CM ratio just calculated as contribution margin divided by sales, and we can do that in total, or we can do that on a per unit basis, and we get the same number, right? So for RBC, the CM ratio is calculated as total CM, 80,000 from our income statement earlier, divided by sales of 200,000, or 40%. We also can calculate that on a per unit basis. The unit CM for the bikes was 200, divided by the selling price of 500 for the same 40%. Now the reason the CM ratio is a useful tool for us is because it tells us the portion of every sales dollar that is left over after deducting variable expenses that can go toward covering fixed expenses and generating a profit. In other words, for every dollar increase in sales that RBC can drum up, they're going to increase potential profit, so contribution margin first, by 40 cents. As I said a minute ago, we can also calculate the CM ratio on the per unit basis. So for RBC, that was the $200 CM per bike divided by the $500 selling price per bike, or 40%. Now the variable expense ratio is also a useful tool for us to think about these interrelationships of line items on the income statement essentially, And it's just the difference between 100% of sales and that CM ratio. Or we can calculate it as the variable expenses, either in total or on a per unit basis, divided by sales. So for RBC, that's the 120,000 in total variable expenses on their income statement, divided by sales of 200,000, or 60%. And again, with a CM ratio of 40%, I could also find this by just taking 100% minus the CM ratio of 40 to get my variable expense ratio of 60. The reason those add up to 100, they're both expressed as a percent of sales. So we always have to account, if you will, for 100% of sales. Now there's a few different things we can do with this tool of CM ratio, right? So let's look at a quick example here. If RBC increases sales from 400 to 500 bikes, or is expecting an increase in sales from 400 to 500 bikes, we can know pretty quickly what effect that's going to have on potential profitability because of our use of that CM ratio, right? Or at least that's one application. In other words, this increase in sales of 100 bikes generates $50,000 in additional sales dollars. CM would then increase by 40% of that. 50,000 times 40% is 20,000, and there's my increase in profit. And then I just proved it out here. At 400 units, that was break even for RBC, so their net income was zero. At 500 units, they've got sales of 250,000, which leads to contribution margin of 100,000. I could use CM ratio again there, right? 250,000 times 40%, or 100 grand, minus fixed expenses of 80,000, and there's my net income of 20,000. Okay, so CM ratio, one more time, tells us what portion of every sales dollar is potential profit. Right? So first, potential profit needs to cover fixed expenses, and then can generate some net income. So let's try one here. Coffee Klatch is an espresso stand in a downtown office building. Let's assume they're selling relatively cheap coffee here. Average selling price $1.49. The average variable expense per cup, so coffee beans, water, whatever, 36 cents. Average fixed expense per month, maybe rent, is $1,300. An average of 2,100 cups are sold each month. What's the CM ratio for Coffee Klatch? So work through that real quick. Pause this video here and then come back for the solution. So that would be B, 0.758 or 75.8%. So that CM ratio, we can take the unit CM divided by the unit selling price. Unit CM is selling price minus unit variable cost. So $1.49 per cup is what I'm selling coffee for, minus 36 cents per cup in variable expenses. Take that difference divided by the $1.49 selling price, and I get that CM ratio of 0.758. Now, incidentally, if we're looking at the other answers there, we want to keep in mind CM ratio can't be greater than 1 or 100%, right? Because we're expressing this as a percent of sales or percent of the selling price. So that cannot be greater than 100%. Okay, learning objective 4 was to show the effects on net income of changes in variable cost, fixed cost, selling price, and volume. So starting to put some of this CVP analysis to use, if you will. So first example here, let's think about a change in some fixed cost and some potential change in sales. So what if the managers at RBC are considering pumping up advertising by 10 grand? They're going to buy some new online spots or whatever. And they think if they do that, they'll increase sales from 500 bikes to 540. And the question is, what's the profit impact if we do that? Is it worth it for us to spend $10,000 in advertising to potentially increase sales by 40 bikes? Well, the first way we could do this is to construct full contribution margin income statements at those two sales levels. So 500 bikes, 540 bikes. We had the 500 bikes already, right? That gives us net income of 20,000. I just pulled that forward. At 540 bikes times $500 a bike, we've got sales of 270,000. Variable expenses were 300 per bike. So 300 times the 540, and there's my 162,000. CM's the difference, 108,000. Fixed expenses we're saying would increase to 90,000, increased by 10,000. would leave me net income of $18,000. So in this case, it would not be worth it for us to increase advertising to sell a few more bikes, assuming that our estimates about extra demand and all those things are pretty accurate or reasonable. Now we also can sort of shortcut this using some of our contribution margin fundamentals. We know that each bike we sell contributes $200 toward the bottom line. That's $200 in contribution margin. So if I sell 40 more bikes, then 40 more bikes times $200 means additional CM of $8,000. If I subtract from that the $10,000 in additional advertising expense I'm going to incur in this hypothetical scenario, I get that decrease in net income of $2,000. And that's what we showed in our income statements here. Okay, so all else equal, not worth it for them to pursue this course of action. How about a slightly different scenario here? Let's say that we're considering a change in raw materials, which would change our variable cost per unit, and that might generate some additional demand. So the question, what's the profit impact if RBC can use higher quality raw materials, thus increasing variable cost per unit by $10 to generate an increase in unit sales from 500 to 580? Okay, so we think we're going to drum up some additional demand, make our bikes more popular if we can increase quality through materials. Now this one's a little harder to shortcut because we've got some moving pieces with variable costs and demand. But we could construct side-by-side income statements again, the nice condensed versions here. So at the original sales level, we knew all that information already. Selling 500 bikes led to net income of $20,000. Now we're selling 580 bikes potentially, still at $500 each. So generates sales of $290,000. The variable expenses are now $310 per bike because they've increased $10 per bike. So 310 times the 580 bikes sold gives us total variable expenses of $179,800. CM is the difference between those two. It's $110,200. Fixed expenses haven't changed in this scenario, so the new net income would potentially be $30,200. So sales would increase by 40,000 or 80 bikes, and net income would increase by 10,200. In this case, we'd say, yeah, assuming that our estimate for demand here is probably pretty close, then this would be worth it. So CVP analysis is very helpful for us to think about the relationships between these moving pieces and what it does to profitability. One thing you may have seen in the news a lot lately, or quite a bit lately, is all the streaming wars, right? Netflix and Hulu and all these types of things. And they're often playing around with price changes. And you'll see an article about Netflix, they recently raised the price and lost however many tens of thousands of subscribers. So somewhere in Netflix corporate offices, someone was doing similar analysis to try to project what's going to happen if I could increase the price by $4 a month for subscriptions or whatever it was and lose 30,000 subscribers. What does that do to the bottom line? Right? Those are the types of things that they can do with cost volume profit analysis more generally. So that wraps up the first video here for Chapter 5. Review anything you need to, ask questions as you need to, and then give the next one a whirl on break-even points and all those things.